Welcome to the Killik & Co podcast for the 21st of July. Well, last week we saw markets move into a risk-off position. It was driven by the tragic events around the Malaysian Airlines plane, which was shot down over Ukraine. And we saw some fairly immediate reaction to financial markets, certainly a bid in the bond market, a little bit of a spike up in the oil market, and we also saw some weakness in the Russian stock market, and we'll take a look through some of those charts going forward. But let's turn to this week first of all. And really focus on what we can expect. We are really in the sort of mix of the Q2 reporting season, and this week it is technology that is expected to dominate the corporates. Certainly we're going to be hearing from Apple, which are due out tomorrow, their Q2 numbers. And there are some buy notes that are circulating early on a Monday morning ahead of these numbers, and some weekend speculation that the iPhone 6 was now moving into production, so possibly a Q3 announcement around the introduction of that particular phone. So we also this week have a report out from Facebook, and indeed we also will be hearing from others within the sector. Just turning back a little bit to last week, Google's numbers, they had a sort of a small miss on the EPS line, but a beat on the revenue line. But overall, the Q2 numbers from Google were received satisfactorily by the markets, with the initial indication of a sort of 1% climb on the stock price in the after-market hours. So it still feels that Google is in excellent shape for the oncoming Internet of Things. Now, turning back here to the UK as well, others that are highlighted will be of interest to Killik & Co. Verizon Communications, many investors through their holding in Vodafone will this year have inherited a direct holding in Verizon Communications, and really just a sort of focus on the Q3 area for these sort of businesses in the areas of net neutrality. This is the ruling which may well favour the telecom operators over some of the large internet sites in the US that really control much of the traffic, sites such as Netflix, for example. In the UK here, certainly GlaxoSmithKline, continuing the theme of the healthcare providers. There's been really a tremendous year for the healthcare providers in terms of not only developments in their R&D pipeline, the movement in cancer immuno-oncology, which has been of huge interest in our recent note with Merck and others in the sector, and of course M&A with AstraZeneca and Shire Pharmaceutical both receiving bids for this year. Glaxo itself has really been probably the least exciting of all of the players, but hopefully they can sort of demonstrate their virtues in that result this week. Moving further ahead, Unilever, well, there's news this morning, which we'll discuss a little bit more detail, that their head of personal care is going to go in and run Tesco, as the CEO of Tesco has resigned this morning following a poor trading update. And so Unilever, largely unaffected by that move this morning, the shares are relatively unchanged into a weaker market. And finally, on Thursday, also Visa, which has been really quite a stellar performer over the course of the last 12 months on the really growth in online payments for that business. So plenty, as you can see, that is going to come out for this week. Really, in terms of the macro picture, last week we saw in the US quite disappointing data on housing starts. Here in the UK, it's really the opposite problem. Housing has been very strong, and it is leading consistently to calls for a move higher in interest rates. And that call was given some further weight last week when we saw inflation data in the UK coming through much stronger than expected. The print of 1.9% was higher than the 1.6% expected. These are the minutes, so this is not a decision, this is really the detail behind the decision of no change last month. And up until now, really for the last many years actually, we've had 9-0, 9 of the members voting for no change. The question is, will we see a change to the mix this time? Will it be an 8-1 or a 7-2? And if it is, then that has ramifications for markets. Market still pricing in a sort of interest rate rise for Q1 2015, but if we start to see a break at this juncture, then that may be pulled forward by a month or two going forward. So let's take a look at some of the charts, and I'm going to start with the Russian stock market, just really to sort of put into perspective the impact that was felt last week. You can see towards the right-hand side of the screen, this was really last week's movement of maybe a 7 to 8% decline in stock markets, and a real expectation that sanctions will be increased on Russia, and all eyes really on the US, which so far has largely tried to stand back in getting involved in this situation, but as it's evolved and it's affecting civilians, it's affecting US civilians, there may be a feeling that the US takes a higher profile role in this, and as a result of that, sanctions to be increased against Russia. So certainly there was a real feeling there felt last week on the Russian stock market. In terms of oil, well, we did have a bit of a blip up in oil prices, although that's been sort of to some extent sold into. You can see really this is the Brent crude oil price. Having sort of reached the peaks of 114, it's really been sort of taken a little bit of profits over the last few weeks. So that small blip up towards the end there being sold into. So I think the oil market at the moment is seeing it sort of largely untroubled by the events at this stage. This is WTI just for comparative purposes there, which again just sort of nudging a little bit higher on WTI. That large correction there was a rollover of a futures contract, so it's largely a technical move there on WTI. In terms of coming back to more domestic matters, sterling, as you can see, is really now sort of just rolling over a little bit at the top, possibly the thoughts of an interest rate increase largely priced into in sterling at the moment, and therefore they're really going to be looking for data points going forward as to show the sort of durability of the recovery we're seeing in the economy at the moment, and so they're looking through, I suspect, the first rate rise and as to where rates will peak going forward. So at the moment, sterling sort of moving in a sort of largely sideways pattern. These are some of the stocks for the week. Focus on 2 or 3 of the technology stocks, and you can see here that Apple really very much towards the upper end of its chart for the year to date. Really, this is a sort of $94 price. Question mark is whether it will get back through that $100 level, which it sort of last saw back at the timing of the launch of iPhone 4. So whether we're going to hear anything from Apple at this juncture, I suspect they'll probably leave it a few weeks before the iPhone 6 is coming in, but there is excitement building in Apple for the development of this new technology. Facebook has held very, very well actually, despite the sort of large sort of correction that we saw in many stocks, such as Twitter. In fact, Twitter came off a lot more than Facebook, with its revenue model largely unproven at the moment, whereas Facebook has certainly proved up not only its ability to advertise, but also move into the mobile space. And you can see there that it's really getting up towards the sort of highs achieved in the early part of this year. So a very solid performance from Facebook, and the market's really buying into the strategy that they're employing at the moment. And this really, just as I say, showing Google, despite the sort of headline showing that there was a small miss on profitability, the share price is indicative of the fact that the markets are looking through that and really looking forward to those sort of new themes. So it would encourage you to dust down that sort of Google note that we published recently, as we expect that to be the sort of one of the preeminent beneficiaries of that oncoming trend. This is just a sort of up-to-date chart on Tesco, reflecting the news that you'll be reading a lot more about, I suspect, over the course of the next 24 hours or so. The demise of the CEO, his strategy has failed to turn around the business. It looks like we're going to be seeing something like 12% downgrades to earnings for this year. The market had got $3 billion of profit penciled in for this coming year. That's going to be cut back to about £2.7 billion. So really, it's not doing at all well on the trading front. The new appointment, he's head of personal care at Unilever, so his job up until now has really been negotiating with the likes of the retailers and getting better prices for them. So he's going to be moving to the other side. No particular relevant retail experience, and that may well come to sort of challenge investors' views. At the moment, the view is positive, and that's just that we are going to get some change. but it will be some time, I suspect, before he'll be able to impose his mark on the business. And in the interim, trading is pretty dire. It's not just unique to Tesco, though. Sainsbury, Morrison's, both of their share prices are down on this news. So I think that they feel that the whole sector is coming under pressure. Do remind of our note on Ocado. Yes, it's not necessarily the most profitable business at this stage. It's invested hugely in its capital expenditure to impose itself as a competitor in the online space, but its share price holding up quite well as it starts to erode market share from modest beginnings, but there's certainly direction to that at the moment, which is causing, or one of the problems causing the sector at this stage. Final chart from me, really just going back to this US 10-year yield. I think when we reported on this last week, there was a little bit of optimism coming back into yields. What I mean by that is yields were moving up on optimism of the strength in the US economy. Just see how quickly it's hit back to the bottom end of the chart, and that really is a reflection of a little bit of the risk off that we saw last week with the plane, and also there were some economic data points last week on housing, which I think upset markets. So really, yields not sort of moving higher at this stage, and I still feel that remains a sort of a reasonable backdrop to equities to continue their sort of upward trajectory.